Okay, so it's Stephen here from Share Navigator, and I'm looking at doing an earnings trade on Walgreens. So Walgreens are reporting their earnings tomorrow morning just before the market opens. So the first thing I want to bring to your attention is here the implied volatility. As you can see, it's kicked up, which can happen quite a lot coming into an earnings report. So that's good. We're going to use that to our advantage. And I've done my fundamental analysis on Walgreens, and I think on a worst case scenario basis, I think the share price, if I was picking it up at 75 down here, I'd be happy enough. And then on the flip side of that, I'm not sure it's going to rise above 90 after the earnings report. So I'm going to trade that particular range here. So again, I'll just mark that in here just to show you what I'm talking about. So I believe that Walgreens after earnings will trade above 75. And on the upside here, I don't think it's going to go above 90 up here somewhere. So just looking at the chart at the moment, you can see it's trading here at about 83.50. Now, just a word of caution here. We have a moving average crossover to the downside, which is usually a bearish sign that the shares may fall further from here. But that's just a short-term technical indicator. As I said, on a fundamental analysis, if I was owning these shares at 75, I'd be happy. And if the share price got up as far as 90, I think that's probably the max on the upside. So what I'm going to do is place a short strangle trade, which is the combination of selling a put option at the 75 strike and at the same time selling the $90 call option as well. In other words, I just want the share price to trade in between this range. So I'm going to do that now. I'm going to bring out the option quotes here for Walgreens, and as you can see here, we've gone out here to February the 17th, which is 44 days to expiry from now. So I'm going to bring out my strategy builder. I'm happy to sell the 75 puts, so that's the first part of the trade. And then I'm going to scroll down to the $90 calls here, and I'm also going to sell the $90 calls. So you can see here, just here's the trade here. It's telling you it's the February 75 stroke $90 short strangle. So leg one of the trade is I'm selling the February 17th expiry $75 put. It's given me the delta and the theta for that position and my bid ask spread here. And also the same can be considered here for the $90 call. Down here, what we're just getting here is an amalgamation of the two bid asks spreads for both the short put and the short call. And you can see I'm going to generate a premium here somewhere between 147 and 165. So as you know, we generally haggle with the market on that. So I'll probably look to take in about 155 in that initially, and I'm going to do about two contracts there. So just to show you what two contracts will be in terms of your margin impact, it's €2,170 here. So it's fine for our size of an account here. So I'm going to look to take in 155. And I'm going to click on submit the order. So now the important part, you're going to get your probability calculator here. So you can see here I'm getting about 75% probability. Now if you're not happy with that, what I'd suggest you would do is actually move the call side of the trade up a little bit. So I'll just show you what that looks like. So let's say we wanted to go instead, maybe move this up to the 9250 calls. You can see you're not going to get as much in here, but you've got an extra margin of safety. So we'll probably only take in on this particular transaction here maybe about 123, and our margin is also slightly lower as well. But wait and you see what happens. Our probability is now gone up closer to 79%. So I'm a lot more comfortable with my probability being around there. So I'm happy to forego some of that income to increase my chances of winning. So I'm happy with that. I'm just going to show you what the trade looks like here. So we're selling two contracts of the 75 put. We're selling two contracts of the 92.50 call. In other words, we want the share price to trade somewhere between 75 and 92.50. We know we've got about a 79% chance of winning, and my margin impact here is 1849 on this particular trade. So I'm going to click on override and transmit. So that order has gone into the system there now, and we're just going to have to maybe just haggle with the market a little bit here to get filled. Now normally I would just leave that and let it get filled later on, but because I'm videoing this and trying to demonstrate how you get filled, we might have to come down and bring our limit price down slightly and see can we get filled here. So there you are, you can see we got filled on that. So the bid ask spread had changed quite a bit since we placed the order. We'll just show you what we got filled on there. So you can see we took in 112 in the end for that particular trade. We paid out about $2 in trading commission. So if we just maximize the trade a little bit here, you can see we sold a 75 put and we also sold a 92.50 call for the February 17th expiry. And just to finalize that, I'll just show you what that looks like now in our portfolio window. So you can see here in the very top here, the February 17th WBA February 75 stroke 92.50 short strangle. So you can see here we've got a position of two on that. So after earnings tomorrow, the share price is going to move probably substantially in one direction or the other. Once it doesn't go below 75 or above 92.50, we're going to be happy and okay with that.